Hello, welcome back, guys. In this video, we are taking a look at three big tech companies and will be comparing and contrasting them. These ones are going to be Google, Meta, and Apple. And so, using our tool, we're going to make a little bit of a comparison and see after the stock market has been kind of going upwards lately and the companies have regained a lot of their lost value. Is it a good time to buy any of those? And if you are looking to buy one, for example, which one of the three is the better one? So we're going to be starting with Alphabet here, and I kind of want to take it a little bit, a little bit earlier, like 1 year ago. You can kind of see that the stock price was near 150 over here, and right now it's sitting at 120. So it's up there, but there is a little bit of a room to reach the previous levels. Now, Google obviously is a company that is doing all sorts of things, tons of things, and I'd say the big revenue stream for them is the YouTube ads, is YouTube basically advertising, and so you will see that over the years, the P ratio of the company has been sitting at a similar range as it is today. A little bit higher at some point, a little bit lower at other points. So it was even better to buy it as it was like near $100, for example. But right now it's sitting at 26, 25, which is about fair. And it may seem a little bit expensive, but remember, and I have told this in multiple videos that I've made in the past, it's about what the company is making and also about the overall financials and the overall status of the company, not just, the actual formulas here. You don't just look at a number and be okay, this is a buy or this is not a buy, because there is tons of things working for this company. For example, the fact that it's still increasing its revenue growth and it's sitting at tremendous revenue growth. They have tons of money in the bank, and their net income, free cash flow, they are all going upwards. Yeah, we did have a little bit of a slowdown in the pandemic years, but that's fine right now, and kind of allowed for an opportunity to potentially buy at even lower levels, as you can see here. So this was an opportunity, frankly. And the company has also been buying back shares, and through the years, buying more and more and more and more. And they have also pretty much allowed new people to come in at pretty nice prices. Now, is it a buy over here? Again, we're going to compare and contrast it with the other companies in this video. That is going to be Google, Meta, and Apple, as I mentioned, and we're going to decide which one is the better one. Now, again, obviously, the margins for the company pretty fantastic. They used to be a little bit higher, but still pretty awesome, because this is a company that is basically making money through advertising. It is very high margins typically. And of course, it's a company that doesn't have a lot of debt. It's a company that makes tons of money. It's fantastic sitting over here with Google, frankly. Now, I will be taking a little bit of a quick look because I don't want to spend tons of time dedicated to all three companies here. We are just going to take a little bit of a summarized look, and you can kind of see here through the 10 years of display that the company has been doing better and better, and they were doing like 60 billion to almost 300 billion right now. And this is exactly what you want to be seeing out of your companies. Everything is green over here, as you'll see, with some redness in between. Again, to be expected. There are some years, especially the pandemic years, where the company didn't do that well. But that's pretty much most of the companies because the economies were lagging. And again, the cash flow statement is the other thing that kind of tells you a similar story here, which you can kind of see in the free cash flow, which is super important, from 11 billion to 60 billion. It's a company that you would love to have been in back in 2013, of course. Now, of course, as it's getting bigger, it's not as easy to keep growing at this kind of similar levels. But it's still a company that is making tons of money, and making your balance sheet better also matters quite a ton. And the next company that we're going to be examining, of course, as I mentioned, is going to be Apple. And we're going to do a similar thing. And remember, you can do all this analysis that I'm doing here by being a Patreon and having full access to this tool. You can find a link in the description box below this video, or just visit myinvestorsheaven.com if you're interested. And you will see here in our metrics page a similar thing about Apple, the fact that it has come up from lower levels over here, and it's sitting at the 31 price to earnings ratio and 26 price to free cash flow, which again could be fair. It's there was an opportunity to buy obviously at an earlier stage, but you will see through the 6-month period that it has been going upwards and upwards lately. as it's it's getting better and better in terms of its financials. We had some opportunities to buy at lower levels, for instance, over here. And also, they're buying back their shares. And when you're buying back your shares, these ratios are going to be increasing here. And so this is nice to see as well. Also, a company that doesn't have much debt here and many liabilities, and it's pretty much increasing the revenue, net income, and everything here at a fantastic pace. And yeah, things are looking pretty awesome about this company as well, with high net income margins too. An expensive company that is selling stuff that is pretty expensive, so their margins are pretty high. And similarly, you notice a similar thing here in the income statement of the company. For example, if you take it back to 5 years of display, from 170 to 394. So Google seemed to have a little bit of a more abrupt, pretty much growth, but still Apple is doing fantastically well here, 37 to 99 as well. So, and again, the cash flow statement will tell you a similar story. Again, you can take it back 10 years of display, and you will see that the free cash flow 44 to 111. Again, fantastic increase of its of the money that they're having in their coffers, pretty much. And Apple is a company that obviously, again, somebody would love to have bought earlier in the day. Maybe 2013 would be a fantastic year to buy. Now, between the two, it's you can kind of take a little bit of a look, as I've already shown you through the metrics tab, and see that this one has a little bit of a more expensive P ratio, a little bit of a more expensive price to free cash flow. So Google appears to be a little bit cheaper. Now, of course, they are kind of close. Like Google was like 25, 26. So it's not the biggest of deals here, and these are both similarly great companies. But what we're going to be doing a little bit later in the video, at the end of the video, pretty much, is evaluate them, like use a discount cash flow model and see which one is closer to our standards, which one is closer to where we'd like to buy. But before we do that, let's move on to the next one, which is Meta. And Meta has come off a terrible period again, where everybody was selling it, and as I was mentioning in my videos, that was a mistake, and it turned out to be a massive mistake. And the company from reached almost 285 at some point. I think it has reached even, and it started near the 80s. So in like a 6-month period, you can kind of see here the insane growth that the company has achieved, basically going back to their previous levels, and not even yet. Like you will see that they were higher even at some point. So we're not there yet, but we are moving towards that trajectory. The problem with Meta is that it has become a little bit more expensive right now, and I have actually sold a little bit of the stock that I had, which I bought at, I believe, 158 was my cost basis. And I have offloaded a little bit because, again, it's getting a little bit more expensive, to the point where Apple and Google may seem like better opportunities. Now, I do own Google as well. Apple I don't, but I could be potentially adding some in the future, especially if it goes down a little bit more, if we have a little bit of a downturn eventually. Now, Meta is also pretty awesome because they have been buying back shares, and this is exactly what we'd love to see. All these tech companies grabbed the opportunity to buy back shares as their stock was basically doing worse and worse through the pandemic, and it makes a ton of sense, and that's exactly what you'd like to see as a shareholder that I was. For example, I was actually stoked about that. And the company here also increasing at a tremendous pace. All these three companies that I have been talking about here in this video are definitely worthwhile buys. The only difference is the price, obviously, and the difference, and the thing that we're going to be examining in this video, is which one is the better deal for our buck, is what we are taking a look at here. And again, it's a company that making pretty nice margins as well. Meta, that is, again, advertising company, not tons of expenses, pretty high earnings, pretty high income margins, and again, as you'll see in the financial statements, a company that has been doing tremendously well. So you could have pretty much compared the company to Apple and Google, and have already understood that buying at $80 or $100 or somewhere near that range was basically a steal. And the company, take a look at this, 7 to 117, and again, the net income margins here, 1.5 to 23, and at some actually 40. They had a decline, obviously, the temporary decline. And again, the cash flow statement, 10 years of display takes you to a start of 2.8 billion to almost 20 over here. Again, fantastic. And 40, remember, again, they had this decline through the pandemic years. They had some terrible years in terms of free cash flow, for example, because they were spending tons in the metaverse, and they kind of backed down on that eventually, which is nice to see. Now, we're going to be taking a look at our evaluation, which is pretty important because it will tell us a little bit of give us a little bit of a better idea on what is the cheaper one to buy. And what I'm going to be doing here is I'm going to be very conservative in all three scenarios that I'm going to be trying for all these three companies. And so what I will do is take a look at what they have been doing recently. Obviously, this growth here for the company was terrible because of the specific year was bad. But overall, you will see that they have been doing 25%. Again, that's the average. Of course, I'm not gonna go there. I'm gonna go significantly lower, and in fact, I may try kind of similar growth for all these three companies. Of course, growth could differ and will likely differ between all these three. But I kind of want to have a little bit of a baseline in the case where the economy goes a little bit in shambles and we are sitting at like 5, 6, and 7% revenue growth. Very, very low revenue growth for these companies that have been growing at a tremendous pace through the years, and likely we're gonna be getting some redness here, but I kind of want to gauge the opportunities. That's the idea here, and obviously all our patrons can try different projections here for different revenue growth margins and everything. So obviously, as you have access to the tool, you can try things at your will. It's just that I'm using this for this video just to showcase which one makes a little bit of a more conservative pick is the thing. Now, the free cash flow margins near 90% for the company. I'm gonna go 85, 90, and 95. And, oops, sorry, that is the free cash flow margins that I was talking about. 85, 85, 90, and 95. And the net income margins are sitting recently at 20, but previously they were significantly higher. I will try to go 20, let's go 24, 26, and 28, because I do anticipate that eventually the company will catch up to what they were used to be doing. And the annual return of 13% is what I'm going to be using everywhere. I hit calculate and let's see what we're getting here. And again, because of this revenue growth, which has been obviously very low, and I told you about this, we're getting redness here as expected. Now, of course, that doesn't mean it's necessarily not a buy here, because the actual revenue growth could be significantly higher. For example, it could be 10, 15, and 20. I have made videos and in which I was actually talking about it. But Meta has been getting more expensive. Now, remember, when I was doing these calculations here a few months ago, the company stock price was like 80 or 100. So it was a massive buy. So right now it's getting a little bit more expensive, and I could definitely see somebody waiting here and not actually getting into Meta, even though it's always better to be buying great companies when they are near their lows, or at least near their cheap status, than actually buying companies that are just cheap and not great. You have to remember that. But we did have an opportunity to buy earlier, so this one may be a little bit late, frankly. Now let's try Apple here. And we need to remember where we were here, right? Like we got a significant difference compared to the actual stock price today. And with Apple, again, I'm going to use the same 5, 6, 7, I believe is what I used. Net income margins, again, the company has been doing the same, 23, 24, 25. This is generally speaking what they do. And free cash flow margins of near 110. So I'm going to go, let's go 100, 105, and 110. I love to see when the company, seeing when the company, when the company is actually having similar margins every year, or the averages are very, very close to each other. So 110, 112, or 111. I know what to expect, and this is fantastic. This is what I love out of companies. This is great. And 13% is what I'm asking for, and I hit calculate. And you will see that again we're a little bit off compared to the current price of 185. We'd ideally want to buy Apple potentially near 120, maybe even less if possible. But at 185, it's also a little bit more expensive. Kind of similar, I'd say, to Meta. But maybe Apple seems just a little bit cheaper here for what it is. Again, the margins are probably sitting around these levels, frankly. Again, you can kind of see it here. So we're potentially sitting at this as a normal price with, again, relatively low revenue growth. So that appears to be fair here. So Apple, Meta, and the last one that we're going to be doing is Google. And again, we're taking a look at Google now. And same thing, 5, 6, and 7. And net income margin similar again, 21. I'm going to go 21, 22, and 23. And free cash flow margins near 100. Again, the same thing, 90, 95, and 100. And 13% for the annual return. Let's see what we're getting out of Google. And as you'll see here, with Google, we're sitting at a high of 91 with a current price of 120. And it does appear that Google may actually be, the cheapest of the three right now. And again, you can kind of see it kind of vividly here with our projections. You can kind of compare the difference between the high estimate here and the current price. So obviously, if you have bought near 100, for example, or even less, that's fantastic. But even at 120, which is right now, I think Google is actually probably the top one of the three in terms of how cheap it is. So I would probably, right now, frankly, I could potentially see myself going like Google, Apple, and Meta after that. Because Meta, again, has been getting more and more expensive recently. And, it has suffered quite some loss as well in terms of their the money that they are making, basically. And so this is basically the sequence that I would be using right now. I would probably ask for Google, ask a question about Google first, potentially buy Google first, then Apple, and Meta would probably be last right now. I may make separate videos for all of these companies just to examine them separately for people who are interested. Let me know if you would be interested in this one right now. And thank you for watching, guys. Again, leave a like and subscribe. That helps a ton. And I'll see you in the next video. Bye-bye.